Okay, so good evening, everyone. Let me know if you have trouble kind of hearing what I'm saying. So for today, what we're gonna do is just like what I have said in the agenda. So we're gonna go over some of the common problem you guys have in this week's Q&A. By the way, I think you guys did a great job for this week's Q&A. The title is very clear, so that's another thing. Just make sure every time when you have any questions about the homework assignment, label the questions as it is so the other student can know when they have the same question, they can just look at the post. So I think a lot of you kind of working through different method. You use like the calculator, you use Excel, or you may be using the online platform. All of those will be very helpful, which will be great. Okay, so the first questions I'm gonna go over. Again, if you have any question, you can just use the chat and just let me know. So the first question I'm kind of going to go over is actually from chapter 4, assignment 3. Okay, so that'll be the second questions. So let me see if I can share the screen with you. Stop. Okay. So I think, sorry. Okay. So I kind of want to look over this question first, because this question is actually a really good example showing you how you should actually start things using a timeline. So the question says you're planning to save for retirement over the next 30 years. To do this, you will invest $830 per month in the stock account and $430 per month in the bond account. The return of the stock account is expected to be 10.3%, and the bond account will return you 6.3%. Okay. When you retire, you will combine your money into an account with an annual return of 7.3%, assuming the return expressed in APRs. So essentially, the idea is you really want to make sure to actually do the following, right? You start with a timeline. So you want to split the two security because the stock and bond actually has different payment. Okay, so the stock has $830 while the bond only has $430. So you will do the timeline for stock and then do another timeline for the bond. Okay, and then again making sure it's monthly payment. So if you're making monthly payment, that will be 12 months per year. Okay, so for 30 years, that means you actually have 360 payment. So that's the first thing you want to clarify. Okay, so in this case, if the stock is getting so the discount rate, for the stock, right, it's gonna be 10.3, but that's again for the whole year. Okay, so a lot of times when you see a return or a discount rate or an interest rate on the question, it's usually applied for the whole year. So always making sure to make adjustment, make sure the return is actually corresponding to your compounding periods. So if you're making monthly payment, that means it's compounded monthly. Okay, so if it's compounded monthly, then instead of using 10.3% for the whole year for the stock account, you're actually gonna use 1/12 of that return. So that will be 10.3% divided by 12. So that's going to be the first easy mistake students tend to make. You don't make the adjustment for the interest rate. Because the idea is if you don't adjust it, you simply assume every month your account is actually making 10.3%, which if you multiply that by 12, that's going to be 120 something, which is incredible. And then you don't usually see a stock account earning 120% over 1 year period. So just be really careful. Always make sure to make the appropriate adjustment if it's compounded more frequently than a year. Okay. All right. So what we will do is you basically try to use the annuity formula, figure out the present value. The reason you can apply the annuity formula because you have exactly the same cash flow for a limited time period. If the cash flow is not the same, if you have like 800 today and then 600 next year or 1500 the following year. It's always fluctuating. Then you cannot use annuity formula. Annuity formula only works for two scenarios. One is you have a fixed cash flow. The second is you have a fixed growth rate. Okay, so either of these two kind of condition satisfied, then you can go ahead and use the annuity formula again. Also, the time has to have a limit. If it's going to work forever, then it's a perpetuity. Okay, all right. So again, so for the annuity formula, we usually would say it's just C over R, times 1 minus 1 over R to the T's power, right? Where T going to be how many times you make exactly the same deposit or you receive exactly the same amount. In this case, it's going to be 830 in this case, it's going to be 360 because you're making 12 payments a year for 30 years. That's combined to be 360 payments. Okay, so making sure you need to adjust your time periods if you compound it more frequently than annual. Okay, and then you also need to adjust interest rate if you compound it more frequently than annual. The payment in this case, you don't have to make any adjustment because the question provides you with a monthly payment. So essentially, it's already adjusted. If for whatever reason the question gave you an annual payment, then you still need to make the adjustment, assuming it's paid kind of monthly. Once you figure out the present value of both stock and bond, then you kind of combine them together, right? The idea is you want to know, after you retire, you combine your money together into an account, and then it's gonna grow at 7.3%. So again, making sure to know exactly how much you have at the time of the retirement. Okay, so once you have that, the next thing you're going to do is you're going to make sure to grow that again. So the combined amount now is going to grow at 7.3%, for your retirement age in this case. And then it's going to be after retirement, you have 300 withdraw, so you can actually figure out how much you can actually withdraw every month. So it works the same. Initially, you're just forming the present future value calculation for the annuity. The second part is you still use the formula, but then you're solving for the cash flow there. So notice I have a question in the chat, I think. Is it possible to record this meeting as a video so we can review it in the future? I usually record it as a video. The only problem is when I try to post it, they usually show the video appears to be too big. I will try to see if there's any way to actually post the video. If not, what I can also do is I will probably do some screenshots of these questions and then post it like pictures. Okay, so that might also work if the video option appear to be too big. Okay, I will definitely consider that. Okay. All right, so the second questions I want to go over is number 4. Okay, so let me just go back. I think number 3 is okay. I don't see any of you actually asking. So number 4, some of you was kind of like really stressed out with what's going on in number 4. So number 4 is a very classic growing annuity questions. Okay, the reason it's a growing kind of annuity because it has an increase. It says the cash flow will increase by 5% per year, right? And then again, it also says they will go out of print 6 years from now. So first of all, it tells you there's a growth rate. The second thing it tells you, it actually stops after a certain number of years, which means it has to be a growing annuity. So now you identify what the question is. The next thing you're going to do is you're going to go back and to the lecture slides, figuring out what is the appropriate formula. So in the lecture notes for the annuity part, annuity topic, the last part of the annuity topic is the growing annuity. There's actually a big kind of formula introduced there. The formula has like C over R minus G, then times 1 minus the parenthesis 1 plus G over 1 plus R, and then close with to the r's power. So that's the formula I was talking about in your annuity topic. Okay, so always read the question first and then take out the keywords. It's really important. The idea is you have to recognize what problem you are having before you can moving forward. So once you identify the keywords, you'll know what question is about, and then you can actually identify the formula. So now you have your formula in front of you. That's when you can actually just plug in the information. So in this case, your cash flow is going to be the 22,000 because it says the cash flow from increased sales will be 22,000 the first year. So that's the cash flow. Again, it says the first year, so that's C1. So for any growing annuity or any growing perpetuity, the C you normally see is going to be the cash flow on your first year. So if it's 22,000 for the current year, then you have to grow that one. But apparently it's actually for the first year, so that is already a future cash flow. So you can go ahead and include it in your formula. So you have your C there, and your R is going to be the discount rate, which in this case, it's the required return of 12%. So that's your R, and your G is a 5%. And your T is going to be 6. So all the information is given in the questions, okay? And once you figure that one out, the next thing you're gonna do is you're gonna basically just try to figure out, kind of like compare, because it has a cost of 95,000 and the present value of this growing annuity is actually greater than 95,000. So that means it's better, right? It makes you more money than how much it's gonna cost you. So the benefits outweighs the cost, so the company should actually proceed with such project. Okay, so be careful with the growing annuity formula. I think the one I provide you in the, I remember reading a post, a student was asking, are there a difference between the formula I provide you in the post when I answer your question versus the annuity formula I provided in your lecture notes? And my answer is they're essentially the same, okay? And the reason they're essentially the same is basically what you do is you kind of like doing some algebra manipulation. So you can start with the lengthy formula. I post it when I answer one of your Q&A posts. Okay, so that's the longer formula. And then if you realize, we can actually try to see that. Let me try to see if I can show you with my whiteboard. Okay, so I'm gonna just do the whiteboard here. So the formula, okay, so the formula I believe I show you on one of the posts was like this. Okay, so I say this. Okay. I have 1 over r minus g, and I'm gonna subtract 1 over r minus g, and then multiply 1 plus g divided by 1 plus r, and then to the power of t. Okay, and I kind of close the whole thing. Okay, so the formula actually looks pretty scary because it has a lot of parentheses and stuff like that. Okay, all right. So the other formula we have in the slide is actually much shorter than this one. So now let me kind of show you why that's the case. So what I do, okay, is I'm actually combining some terms. So I'm basically trying to combine the things within the brackets first, the large brackets inside here. Okay, so I'm trying to find my common denominator here. So what I have is I'm leaving my C out as it is, okay? So my numerator is going to be, okay, my numerator is going to be 1 plus r to the t's power minus 1 plus g to the t's power And I kind of close it and then divide it by my denominator, which is r minus g times 1 plus r to the t's power. Okay. All right, so now I know it looks like I'm making things more complicated, but what happened is if you write it to top and bottom, the reason I can do that because I'm finding the common denominator here, right? So for my first fraction, my denominator is r minus g. For my second fraction here, my denominator is actually r minus g times 1 plus r to the t's power. So when I find my greatest common denominator, that will be r minus g times 1 plus r to the t's power, because that's the denominator applies to both of them, okay? But then you notice here, for my first fraction here, I don't have the 1 plus r to the t's power term, right? So I multiply both numerator and the denominator with this 1 plus r to the t's power. So that's the reason you see this component over here instead of seeing a 1, okay? So now what happened is you can actually continue manipulating the algebra. So I'm taking my denominator r minus g out. So what I'm going to do is I'm going to have my c divided by r minus g. That is going to be my common factor. Okay, so once I take that one out, what I have in the remainder of my kind of bracket is just going to be, I think, 1 plus r to the t's power, and then divided by 1 plus r to the t's power. Okay. And I'm going to have a minus 1 plus g to the t's power, and divided by 1 plus r to the t's power. Okay, so this is what I'm gonna have now. And then if you notice here, if you're looking at my denominator, actually if you're looking at what inside my big bracket here, the 1 plus r to the t's power divided by 1 plus r to the t's power actually cancel each other out. So that's gonna be 1 actually. So what you're gonna have is going to be c divided by r minus g, and then you close it up, and then you start a big bracket, and then now the only thing you have is the whole thing here is going to cancel out. So that's going to leave you with 1. So it's going to become 1 minus. And then things you have to the t's power for both numerator and denominator. So what you can do is you can actually combine the two together into one bracket. So you'll have, and then divided by 1 plus r, and then you close this whole thing and then take it to the t's power. Okay, so now this is the equation I provided you on the slides. Okay, so now you can see it's essentially the same. The formula I provide you in the post is identical to the formula I provided you originally in the slides. Okay, so depending on what formula you feel more comfortable with, but either way, it is a formula for the growing annuity. Okay, so the C here is going to be the cash flow you receive or you deposit in the first year. And R is a required rate of return or the interest rate or the discount rate. And the G is going to be the constant growth rate. The T is going to be the number of periods, how long the annuity is going to last. Okay, let me see what questions you have. Yeah, it's all random. That's why the reason the question is actually designed that way. So the idea is you're going to learn the process. not just to copy the answer from the other one. So when people kind of try to show you how things work, you're actually trying to learn the concept, not just trying to say, oh, this is a number, I'm gonna put in everything. So you still have to practice when you read other posts. Okay. But that's the reason I always ask your student to actually pose complete questions, right? So that way you know exactly what question they're talking about, what numbers they're getting. Okay, so actually help you to think better. So instead of just saying, oh, this is the same question, let me just use exactly what they are doing. Okay. So next time when you do any post, try to make sure to be as detailed as possible. Everyone else, if they haven't seen the question, they need to be able to know exactly what the question you're asking. So ideally, they should be able to see the question without going back to the connect and then try to figure out what question is there. Okay. So that's why whenever you make any post, label the questions from which assignment and what number, and then copy the entire question there, and then try to let people know where you're stuck, what kind of steps you have taken, and then maybe try to see, this is what I think, but I got some wrong answer. Can you guys kind of help me with here and there? I think I start to see some more of these type of questions, which is really great, because by asking these questions, you actually are really putting more thoughts into it. You're trying it, and then you notice something is wrong. So that's very good. Okay, so let me just go back. I'm going to do my sharing. All right. So number 4 is a growing annuity. Okay. That's essentially the same. Number 5 is essentially the same. I think the only trick thing about number 5 is you understand it is a growing annuity, because it says it's kind of your salary will grow. It will increase by 2%. And then you also deposit for a fixed time period, so you know it is a growing annuity. But then you might accidentally using the wrong initial deposit, because it says over here, you're going to deposit starting next year, right? Beginning next year. So by next year, your salary is actually higher already. So you have to make sure to account for the 2% increase for next year's. So before you actually, using the 10% of 59,000, now you should actually use 10% of the salary after the 2% growth. So you need to figure out how much your new salary is going to be next year before you can figure out what's the cash flow you're going to deposit the first term. So I think that's the only likely mistake you're going to make. Okay. And yeah, so number 6, I think overall you guys did pretty okay. I think some of you asking how to proceed number 6, but the idea is you comparing two options, and the only way you can compare is by getting the present value. So always make sure whenever people ask you which option is better, how should you proceed, whether or not you should accept something, always look for the present value. So if you're trying to figure out the present value, then your option A, first of all, they are both annuity, right? Because you actually get annual payments for a fixed amount of period. In this case, your A has a T of 32 because of 32 annual payments and a payment of 320,000, right? But the problem is it's not 320,000 cash flow because you have a tax, right? It's 25% tax. So you want to make sure to figure out what's the after-tax amount. That's your cash flow. So getting the after-tax amount for A, same thing, getting the after-tax amount for B, okay? But you also notice here, A is actually an annuity due, okay? So that's, because it says the first payment being delivered today. Okay, so that's slightly different from the regular annuity we talk about, or the annuity kind of encountered in previous questions. The regular annuity starts a year from today, like they always say beginning next year, okay? So when you do the timeline, essentially today is 0. A regular annuity will start the payment at time 1, okay? But for option A here, it's actually annuity due. The first payment happens today. So you actually have a payment right away. Okay, so keep that in mind. So it's actually at the beginning of the pay period rather than at the end. So when you actually try to work it out on your calculator, you need to make sure to let the calculator know it is the beginning period, not the ending period. Okay, so if you happen to use the same calculator as the one I'm using, you can actually just go ahead. So with the calculator, not so sure, hopefully you can see me. I can probably stop the sharing. So on the calculator, what happened is you can always just turn it on, right? And I'm just gonna clear everything. So you're gonna go to second, okay, and then you're gonna go to payment. Okay, so most of the time you will see the payment here shows as END. That means payment happens at the end of each pay period. That's your regular annuity. Every payment happens at the end. That's why your first payment is on year 1 rather than year 0, because the end of year 0 essentially is year 1. Okay, but if you happen to have annuity due, like in option A here, what you're gonna do is you're gonna press second and enter. That's going to change it to BGN. That means beginning. So now your calculator knows you're going to compute your annuity, assuming it's annuity due. Okay. So once you have that one, you can just say second and quit. Okay. So the only thing you will notice that's slightly different is on top of a calculator, you actually see the little BGN that indicates your payment type is actually different now. Instead of doing the end calculation, it's at the beginning. Okay, everything else remain the same. You still do the same keying features here. You will still do the same end. In this case, will be like what, 32. So you will say, I'm just gonna do 32 here. So that's still going to be your end. Notice here it's not reduced because your calculator knows how to make the adjustment. Okay, so if you're doing it on your kind of online platform, they also have the same feature. They will ask you, is this the beginning or is this the end? Okay, so beginning means it's annuity due. End means it's a regular annuity or ordinary annuity. Just be really careful if you're doing on your calculator. Once you finish everything, then just change it back. So to change it back, again, you do second and payment. And then you go second and enter. And then you go second and quit. Okay, so now you no longer see the little digits on top. So that means it's actually back to the ordinary annuity mode. So that's how, and then for your graphing calculator, when you do the time value of money, usually in the bottom, they will show you the beginning or the end. So you can just move back and forth. Okay, so they always have something like this when you try to compute. Okay. So let me see. So that's kind of the question I want to go over for chapter 4. So if you have any other question you want to ask about chapter 4, let me know through the chat. Okay, so for chapter 8 and 9, that's stock and bond. Okay, so it's actually more of a continuation of chapter 4. Chapter 4 starts you off with time value of money. It introduces you with perpetuity and annuity, kind of shows you different method to discount, different cash flow. So in chapter 8 and 9, you're basically utilizing this method. Okay, so the first question I think I'm going to look at is actually number 2. A lot of you stuck at this question. It's a very classic bond questions. There are 2 types of bonds here, and I think you guys have no trouble with the second bond. The second bond has a face value of $40,000 and a maturity of 20 years, makes no coupon payment over the life of the bond. So that means it's a pure discount bond, right? So the second bond, I think all of you have no trouble getting it. So on your calculator, you will say, okay, I have N is going to be 40,000. So I'll have just 40,000 here. So I do the 40,000. Oh, sorry. And so N is going to be 20. So I would do 20 for N. And then 40,000 is a face value. So I do 40,000. That's my face value. And then The coupon payment is going to be 0 because it says it pays nothing. And then I over Y is going to be it's going to be actually 4%. Okay, it's because semi-annually, so I over Y is 4%. So that means we also need to adjust the maturity to 40. And you're computing for the present value. Okay, so you're getting the present value right away. So a couple of things to keep that in mind. I think you notice the question says the return on both bond is 8% compounded semi-annually. But most of the time you associate the compounding with payments. Okay, but in this case, they don't make any payments throughout the life of the bond. But that doesn't really matter. If it's compounded semi-annually, you still need to make the adjustment, even though it doesn't have any coupon payment. Okay, it really just means the interest supposedly need to accumulate biannually. Okay, so you still need to make the adjustment. So for semi-annual, bond, there are 3 adjustments to make. Okay, so that's what I kind of want to put on here. So adjustment for semi-annual bonds. The number 1 is N. So N needs to be doubled, right? If it's 1 year, it becomes 2. If it's 10 year, it becomes 20. If it's 20 year, it becomes 40. The reason you need to double that because you actually receive 2 payments, supposedly, every year, even though in this case you don't receive anything, but you still have to make sure to adjust for the compounding periods. And the second thing you're going to adjust is actually I over Y. Okay, so I over Y needs to be divided by 2. Okay, so you're going to half that one. Okay, because for the whole year you have 8%, but for every half year it's only half of it. And another thing you're going to adjust is actually the coupon payment. Okay, so I will say the payment. The payment also needs to be divided by 2. Okay, so normally you will have, so every time when you see the coupon rate, in this case, it's no coupon, so it doesn't really matter. So essentially, it's just 0. 0 divided by 2 is still 0. But if you happen to have some coupon, let's say if it's 2%, then that means every year you're getting $20, and then every half year you're only getting $10. Okay, so yes, another thing I do want to mention, if you don't see the question mentioning about the face value of the bond, always assume it's $1,000. That's actually a very safe assumption because that's a very common type of face value bond. Okay, all right. So the challenging part is actually, for this problem, it's more of bond M. Okay, so for bond M, it says has a face value of 40,000 and matures in 20 years. It makes no payment for the first 6 years and then pays 2,000 every 6 months over the subsequent 8 years, and then pays 2,300 every 6 months over the last kind of like. So you have a 0, and then you have 2,000, and then you have 2,300. Okay, so I'm gonna writing down these numbers because what I would do is I'm gonna start again, do a timeline. So for bond M, you draw a timeline. I know it's not very straight, so bear with me. So timeline always starts at 0. So this is your 0, that's the beginning. So it says for the first 6 years, it doesn't pay anything. And we know it's semi-annual compounding. So when you do the timeline, you also need to make sure to actually label the time biannually. So in this case, that means you actually have 12 half year. So the first block you're going to do is actually going to be 12. Okay. And then after that, it's going to make $2,000 every half year, for 8 years. So 8 year means that's going to be 16 half year. Okay, so we're going to over here. So if you add 16 to 12, that means the second point going to stop at 28. Okay, and the last one is again, 23,000 for another 6 years. So 6 years, that's going to be 12 periods, which means by then it's going to be 40. Okay, so this is how you're supposed to label your timeline. So again, so 0 here, and then 2,000 here. And then you have 2,300 here. All right. So what you need to do next is now you have everything labeled clearly, and you know that there are actually 3 annuities. They're actually separate. The first annuity starting at time 0 and finish at time 12. Okay. And then every period you have a discount rate of 4%. So, you could discount it, and apparently it's going to be just 0 because 0 discounted by anything is 0. Okay. And the other 2 annuity, I think that's really easy to miss that if you don't have the timeline, is actually delayed. Okay. So for the second annuity, you're going to have $2,000 every half year for 16 periods at the discount rate of 4%. Okay, so if you're just solving for that annuity, I kind of just talk about, and then you will be able to actually easily get the present value there. Okay, but then the problem is, whatever you do, because this is a delay annuity, so what you're getting, you will be able to get the value of this portion over here, but the value you're getting is going to be at this point. Okay, so you have to make sure to discount it back 12 periods. So I think a lot of you made the mistake of not discounting it further. So every time when you see a delay annuity, any annuity that starts a couple years later, that means it's delayed. If you don't see your payment right away, that is a delay annuity, because regular annuity starts the payment on first year. If your payment is not starting on first year, then it is a delay annuity. So for any delay annuity, you need to make sure to discount it back again. Okay. So for your third annuity, again, you will use the 2,300 as your payment, 12 as your N, 4 as your I over Y, right? And then you will still computing for the present value here. So what you're getting is the little area here at time 28. So notice here, again, it's actually delayed for 28 periods. So what you need to do next is you actually need to discount it back by 28 periods. So that's the reason you have a 12 and 28. That's a further discounting. It's really about bringing what you have back to time 0, because the goal is you have to know exactly how much the bond is worth today, which is at time 0. So if you stop anywhere after time 0, that's not accurate. So again, so just making sure to discount it back. The timeline really help you to see exactly what's going on when you actually have the cash flow. Like if you don't have the timeline in front of you, it's gonna be very easy for you to miss that. All right. So once you have that, again, so just discount, blah, blah, blah. So, okay. All right. The next questions I want to go over here in this assignment is actually number 4. I think I can probably just go over number 5 first, and then we're going to go to number 6. Number 4 and number 6 actually are very similar. Number 6 are actually more complicated. So let's see number 5. So number 5, I think it's pretty straightforward, A and B. Some of you get stuck at part C because you probably don't understand what the term implied return means. So implied return essentially is asking what's the return for the investment, okay? So the typical formula for implied return is actually just try to compute what's the percentage you're getting back for the dollar you invested, okay? So when I say this, that really means you have this. Okay. So what you have is okay. So what you have is, let me see if I can make it bigger. Okay, so implied return formula is actually typically equals to P1 minus P0 plus dividend, and then divided by P0. Okay, so this is actually the exactly same formula for your rate of return calculation. So what happens is it's really just your initial investment is P0. That's how much you invested originally. P1 is how much you can get back. Like at year one, how much do you sell your stock for? So P1 minus P0 essentially is the change in the price, right? You purchase it at P0, you sell it at P1. So if P1 is higher than P0, then you have a capital appreciation. In other words, you have a capital gain, okay? And then if P1 is less than P0, you should have a capital loss, lose money in the capital. So the difference between how much you sell and then how much you buy, okay? That's the change in price. And then you have the dividend. Dividend is the additional kind of income you receive for your investment if the company does pay some dividend, okay? In this case, the company says they don't pay any dividends, so you can basically just eliminate that term, the dividend term here. So what you're going to really have is just P1 minus P0 and divided by P0. Okay, and a lot of you notice it actually turns out to be exactly the same as a growth rate, okay, which is essentially how the question is designed because no dividends are given out. Okay. All right, so the next questions I'm gonna go over is number 6. So number 6 is essentially very similar to number 4. But the reason I think I only need to go over one question and then you should be able to solve, clear the other one. So I think I'm gonna do the same thing here. I'm gonna use the whiteboard. Yeah, let me just write down the number first. Okay, the number apparently I got is slightly different. So it says the company just paid a dividend of 1.95. There are a couple keywords I do want to mention. When you see the word paid, that's actually pretty important. That means it's a past tense, it's a past dividend. So you should not discount a past dividend, okay? So a dividend that just paid means it happens at time 0. So in this case, your 1.95 is dividend 0, okay? And then the dividend is going to increase by 24%. So you have 24% for the first year, and after that, it's going to be reduced by 6% every year until it reaches average of 6%. So that means after 24%, the next year is going to be 18%. Following that, it's going to be 12%. And following that, it's going to be 6%, which is going to last forever. Okay. And then the required rate of return is going to be 16%. Your goal is trying to figure out what is the price for the stock. How much should you sell the stock for? Okay. So to do these questions, trying to see if I can actually. So again, so you will start with a timeline. Okay. So at time 0, that's your 1.95. And then after that, year one is going to be growing at 24%. So we will actually label your timeline. So that's going to be 24%. In year one and two, you're going to have a new growth rate, which is 18%. And then between year 2 and 3, it's going to be 12%. Okay. And then after that, it's going to be 6%. So what I normally do like is actually draw a separation line. That's what I kind of show you guys on the videos as well. So I like to show the dotted lines because after this, that's when you have the constant, the terminal period, which is a 6%. And that's going to last forever. Okay. So everything is very clear. You know 1.95 is dividend 0. So dividend 1 is going to be 1.95. I'm just going to, I think I should be able to just do the tax eraser. Okay. Let me just do the tax. So essentially what I'm going to do is my dividend 1 is going to equals my dividend 0, which is 1.95 times 1 plus the 24%. Okay. And my dividend 2 is going to be 1.95 times 1 plus 24%, and then times 1 plus 18%. And my dividend 3 is going to be 1.95 times 1 plus the 24% times 1 plus 18%, and then continue times 1 plus 12%. Okay, so these are my 3 dividends in the explicit period, right? Explicit period is year 1, 2, and 3. For my terminal period, I need to know at least 1 dividend, right? So my terminal dividend, my terminal period starts at year 3. So the only dividend I need to know is going to be my dividend 4, which is going to be 1.95 times 1 plus 24%, and then times 1 plus 18%, times 1 plus 12%, and then times 1 plus 6%. Okay. So notice here, I really like to break things down. I think it's really helpful when you break things down into, into little pieces. Like in this case, the reason I like to do the calculation for dividends is so you can actually see what you are discounting, right? You have the explicit dividend and then you have the terminal dividend. So for the explicit dividend, all you're doing is basically just discounting them by the corresponding discount factor, right? So your first dividend needs to be discounted by 1 plus 16% to the first power. The second dividend needs to be discounted by 1 plus 16% to the second power. And the third dividend needs to be discounted by 1 plus 16% to the third power. Okay, so that's the calculation for the explicit period. For your terminal period, because it is a growing perpetuity, so you're going to apply the growing perpetuity formula, right? So it's going to be the dividend 4 divided by the difference between your discount rate and your perpetual growth rate. So it's going to be dividend 4 divided by R minus G. So that's 16% minus the 6%. We also realized that the terminal period also has a delay. It doesn't start until year 3. right? So there's a delay of 3 years. So that means you're going to discount whatever you're getting for your terminal period back by 3 periods. So it's going to be divided everything together by 1 plus the 16% to the third power. Okay, so the mistake usually I see students making is not sure when the terminal period starts. And you can basically eliminate this mistake by doing the timeline. Once you have the timeline correct, and it's really easy to avoid this mistake. Okay, so again, so always try to grow into a habit of using the timeline whenever you do a time value of money calculation. Okay, so any questions about previous week? You will see similar things again, you know, this week, and then also during the kind of a final exam. So make sure to practice a little bit, understand what's going on, and then that's pretty much it. For this coming week, so what happens is you continue with time value of money. Okay, I would say the first chapter is going to be a bit easy. It's about, you know, evaluating projects. So you're going to do the project evaluation. You can easily kind of get that one done if you actually try to. So if you try to do the NPV, classic net present value calculation on your calculator, make sure you're going to utilize this, right? So let's just quit everything. So you're going to use your cash flow. The cash flow key is right next to the second. So I'm going to press that. Always make sure to clear your memory before proceeding. To clear the memory, you will do second, and then clear. Clear is all the way in the bottom. So that's a CE-C. So that means everything's going to be cleared. So you will notice it's a CF0. So that's asking you what's the time, you know, what's the initial cash flow, like what's the initial investment. That's what CF0 means. So once you once you put that one in, you're gonna go down. So press the downward arrow. That's gonna show you C01. So that's asking what's the first cash flow you receive in the first period, right? Originally, your initial investment is going to happen at time 0, and then after time 0, it's going to be your future cash inflow. So you will do whatever the amount here is. Once you're done, make sure you press the enter. So let's say if I do 100, hypothetically, so I will put 100. The idea is I want to make sure my calculator knows I'm putting 100 in. So in order to let my calculator knows, I'm going to press the enter key. So once you press the enter key, you will see the equal sign. Okay. Do not use the bottom equal. It doesn't work. Okay. Has to be the enter on over here on top for your calculator, for your financial calculator. So once you have that one done, the next thing you're going to do is you're going to click the downward arrow again. You will see the F01. F01 stands for frequency. So it's asking you how many times did you receive the $100. So let's say if you have $100 for the first year, $100 for the second year, $100 for the third year, that means you received the $100 3 times. So in that case, you're going to do a frequency of 3. So you'll say 3. And then again, I'm going to press my enter. Okay, so enter always means to let the calculator remember what's going on. Okay, so once you're done, the next thing you're going to do is you're going to press the downward arrow. So that's when it's asking C02. So this is asking you what's the next different cash flow, like the initial cash, the first cash flow you have is 100. If you happen to have a 200, the next cash flow, and then you're just going to put 200 and so on and so forth. Okay, so once you are done, the very important thing is you're going to have the calculator compute for the net present value. So you're going to go to the NPV, you're going to press it, and then it's going to ask you what's your I. I is the discount rate because you're trying to compute for the net present value, which requires you to discount. Okay, so in order to discount, you have to have the discount rate. So the question usually provides you what's the required rate of return. So that's when you do the, let's see, the required return being the 10%. So you would just say 10. And then again, you're going to do the enter. Okay. So once you're done, you're going to press the downward arrow. Now you see the NPV, right? It shows you 0 because it has not calculated anything yet. To let the calculator compute for the NPV, you're going to press the compute key. Okay, so it's going to compute things for you. Okay, that's the answer. So that's for your NPV. For your IRR, what you need to do is you're going to go to the IRR key, which is right next to the NPV. And then notice here the IRR doesn't ask you for anything else because it is a discount rate that gives you 0 NPV. So it doesn't need you to input any discount rate. So if you try to compute for the IRR, all you need to do is just press the compute key. And it doesn't calculate anything in this case because I didn't give you a negative amount. So that's one thing about IRR. The only way you can calculate for IRR is when you have a both positive and negative cash flow. So you have to have a cash outflow and you have to have a cash inflow in order to compute for IRR, because otherwise there's no way your NPV is going to be 0. Okay, so the definition for IRR is it's a discount rate that sets your NPV to 0. So just be really careful. If your calculator doesn't compute anything for you, then that really means the cash flow you're giving it is actually incorrect. Okay, so just double check that. And when you try to use Excel to compute NPV and IRR, also be really careful, especially the NPV. Definitely make sure to review on the website I posted on the Learn portal. Kind of shows you what kind of like the things to avoid when you use Excel, because Excel has a different design as the calculator. They usually assume the first cash flow as cash flow 0, so they have actually a lag in the time period. So you need to be very careful when you do calculation on Excel. Try to figure out the net present value there. Okay, so the key is, again, so the net present value calculation, read the question very carefully and then try to determine what's going on. And then following the net present value chapter, the next thing is actually about this cash flow analysis or discounted cash flow. So understand what is a cash flow, what's the difference between the cash flow and the profits is very important. You usually will start with profits, right? And then you have to make sure to adjust for depreciation. Okay, always add the depreciation back if you happen to have any. If you happen to have a working capital, also need to make sure to adjust that. If you happen to have any interaction between products, right? Let's say you're producing a new iPad, or let's say Apple is introducing iPhone 8, right? So whenever they introduce a new product, you will definitely see an increase in the sales of the new product, which is going to bring in new revenue for the firm. That's a good thing. But at the same time, if you imagine a customer who's only going to purchase one phone, okay, and then walk into a store, if they see iPhone 8, they're probably going to go purchase iPhone 8, which means they're not going to purchase any existing iPhones. Okay, so that means the sales of any existing iPhones is going to be kind of like impact a little bit, with the introduction of the new iPhone. So when that happens, that's what we call the interaction, and that's actually a negative interaction. So if you have any sale loss, you need to make sure to subtract that from your cash flow, because that's an incremental difference as well. So any addition to your sales, any subtraction to your sales need to be included when you compute for cash flow. Okay, and going back to depreciation, just to emphasize a little bit. So when you try to compute for depreciation, usually we will use the straight line depreciation, right? So to calculate the straight line depreciation, you start with how much you pay for the item. Okay, so let's say if you spend $1 million on the asset, you're gonna subtract the salvage value. Salvage value is what's the residual value you can get when you can no longer use the equipment. Okay, so you're gonna subtract that because you never depreciate the salvage value. So once you subtract the salvage value from the initial cost, that's gonna get you the total depreciable amount. And then you divide that by how long do you expect to use it. That's what we call the expected life, right? Usually we will say you can use a car for 5 years. It's not to say you have to use it for 5 years. It's really just a definition, a norm. The expected life for a car is 5 years, just like expected life for a building is 28 years, but nobody really used a building for just 28 years. So the expected life is actually slightly different from the actual life, okay? But when you compute for the depreciation, you are using the expected life, okay? So straight line depreciation will get you the same depreciation amount every year. It's always going to be the same. It's not fluctuating. So that's why we usually prefer to use a straight line depreciation, because it's straightforward. But sometimes you might also have what we call the modified accelerated depreciation. That really is for tax purposes. Okay, IRS usually want company to follow certain depreciation law, which is published by the government, by them. So they will release a schedule. It's a modified accelerated depreciation schedule, and on the schedule it tells you exactly what's the percentage you can depreciate. Okay, let's say you have to depreciate 20% for the first year, 30% for the second year, and so on and so forth. So it's really pretty much set. All you need to do is just identify what column do you belong to. Like if you have a 5-year asset, you're going to use a 5-year column. If you have a 10-year asset, you're going to use a 10-year kind of column. Once you identify the column you belong to, you can just apply the given percentage to compute for the depreciation. Okay, so again, so just keep that in mind. But either way, the straight line depreciation used more often for financial analysis. The modified depreciation method used more, for tax purposes. But it also has some benefits to use a modified depreciation, because when you depreciate a lot more in early years, you really encourage company to purchase more asset. So they do more turnover or turnaround new assets. Okay. So I think that's pretty much it I want to mention. And for the investment project, because today is a holiday, I actually don't get to see anything. So tomorrow I will post, I will let you know which group actually did the best over the past week. So the group actually has the highest kind of portfolio value over the past week, has the biggest change, will get some bonus points, just like the ones labeled on the instruction. So keep investing. And again, it's okay to actually switch strategy. If you think last week the strategy you utilized is not very good, feel free to change it, but make sure to actually keep a record of your old strategy, and then also maybe write it down to see why you think it's not good or why you want to change it, things like that. I think Nancy asked about the format for the report. How long do I want it to be? I didn't really put a page limit because I don't usually want to impose any rules about that. For me, it's more about the content. You have to let me know exactly how your investment project has been going over the 3-week period. And you have to let me know what kind of decisions you're making, what things do you think that's relevant, that's good and interesting you want to discuss with me. So ideally, I want it to be like 12 pages, more or less, double-spaced, and excluding probably like the tables and chart appendices, if you happen to have any. But if you don't have enough to say, it's okay. It's not a big deal. I really don't want you to say a whole bunch of things that's not relevant, but you just want to say it so you can have the right page limit. That's something I want to avoid. I want to make sure every time when you write a report, it's actually very concise and it provides everything that you think is important for the reader to understand. So the page limit is not a big thing. Okay, I usually don't mark points off for not catching that. It's really about how well do you write, how well do you actually communicate your idea with whoever is reading the report. So by the end of the day, when I read a report, hopefully, even without seeing how your portfolio performs, I should be able to tell, what has been going on over the 3-week period. And then it should be able to actually allow me to maybe think about the strategies you are taking and then guide me, in my personal investment kind of like strategy, things like that. Yes. I think I will. Yeah, sorry, I think I'm kind of behind on that. I should have done that last week. I will post the homework and the quiz grade either tonight or tomorrow morning. Okay. Yeah. Any other questions? Okay. So if you don't have any questions, and that's it for today, and thank you for joining me. Like I said, I will try to see if there's a way to actually post the complete video up. If not, what I'm gonna do is just do some screenshots and to share with you the steps, the solutions I kind of have you guys look at it tonight. Okay. And then I will keep track of the Q&A and continue participating there. I will talk to you guys next week. Okay. All right, and happy Labor Day. Okay, thank you. Any tips? Week 3 project is actually pretty straightforward, I would say. When you read it, don't overthink it. You know, it's more about can you really get the NPV? I know the question itself is actually pretty long. The case itself is pretty long, but I did show you kind of like the numbers in these tables. So just utilize these numbers and then do the NPV and the IRR and the payback period. And when you do the discussion, always keep in mind the NPV method usually trumps any of the other method because that's usually the method we always go with. So that's a central idea. So just keep that in mind. NPV method is usually better than the other method. If you have a conflict between different methods, you usually want to go with what you're getting out from the NPV. Okay, I hope it helps. And then, yeah, okay, cool. I will talk to you next week. Good night.